and welcome to another episode of Earth911's Sustainability in Your Ear, the podcast conversation with a changemaker working to accelerate the transition to a sustainable, carbon-neutral society. I'm your host, Mitch Ratcliffe. Interest in investing for sustainability has soared in recent years. Bloomberg reports that in 2021, more than $1.6 trillion of debt financing went to corporate and infrastructure transitions to renewable, low-carbon, and low-impact business approaches. That brings the total invested in sustainable paths to more than $4 trillion, or about 4.2% of the value of the world's economy last year. But what about financing for the myriad startups and small business transitions that will bring the sustainable economy to full flower? It's hard to get a business loan, and even harder when you're just starting out. Our guest today, Dimitry Gershenson, is co-founder and CEO of Enduring Planet, a provider of non-dilutive business financing. In other words, they select companies based on similar criteria as a venture company would use without taking stock, providing loans based on the borrower's cash flow. Enduring Planet finances climate mitigation companies that help reduce emissions, carbon removal startups that capture CO2 from the atmosphere, and firms that provide climate adaptation and resilience services that will be needed in response to climate change. They also look for diverse and inclusive companies and those organizations delivering goods and services in marginalized communities. We want to get a sense of the financing activity at the grassroots of the sustainable economy and introduce sustainability-focused startups to the debt financing process. You can learn more about Enduring Planet at www.enduringplanet, all one word, no space, no dash, enduringplanet.com. Welcome to the show, Dimitry. How are you doing today?
So good. So excited to have this conversation.
Well, it's a pleasure to have you here. I want to start off by asking you about your background. You spent some time at Facebook's, at Meta, the company that owns Facebook, and you led their energy access program for underserved markets in Kenya and India, where you turned a $15 million investment into more than $500 million in follow-on financing by other organizations. You must have learned a lot there, but how did that inform your thinking when you started thinking about Enduring Planet as a business?
So our work on the Facebook Energy Access Program was really focused on accelerating electrification in emerging markets. We worked in East Africa, we worked in South Asia, Southeast Asia, and we knew from the very start that we could not be the agent of electrification, right? So we needed to play a role that would sort of enable other organizations, investors, startups, small businesses, whoever, to sort of participate in the market and drive electrification, ideally through clean energy sources. And that was sort of the primary thesis. And one of the things that we figured out pretty early is that we had capital that could play a very catalytic role. And so then the question was, okay, where can we deploy that capital most effectively to have the biggest impact? And we realized that there are these sort of financial mechanisms, often called catalytic capital, where basically you use your money to take risk and then other private investors participate, because otherwise they won't, right? And so this is, there's lots of different ways these products can be structured: guarantees, first loss positions, loan loss reserves, lots of different tools, and we use pretty much all of them in the book. And so we work primarily with financial intermediaries who are very early in their journey of sort of providing capital in these markets, often non-dilutive capital. So these were sort of specialized lenders building their operations to lend to folks who were doing pay-go solar, building microgrids, you name it, they were sort of serving these emerging markets. And so we invested in SunFunder, Lendable, Responsibility. We did some work on the dilutive side with Acumen and Venture Builder. And so by our estimates, our capital not only directly unlocked funding in the funds that we participated in, but then those intermediaries were able to leverage the performance of those funds to raise their follow-on funding. And so when we thought about attribution, because it's really hard to think about impact when you're an investor, right? You have to like figure
Sure.
out what you can actually sort of take credit for. And so the way that we felt was sort of justified was to say, okay, the money we directly unlock in a given fund, that's attributable to us. And then their next fund is attributable to us because it was not possible to do it without the previous fund. And then after that, it's all them.
So how does that get you thinking about a startup in the enduring planet context? You're looking at it both as an asset that will appreciate in value if it's successful, and as leverage.
So, that experience and sort of other experience I had throughout my career working on this at this intersection of sort of capital and impact, it brought me to this point last year where I was starting to think about my next steps and where I wanted to continue to sort of work and have an impact on the world. And looking at sort of the climate crisis and the opportunities that we have today to really drive action towards, what we like to call a new climate economy, unlocking capital for entrepreneurs felt like a really powerful place to exist, right? And there's only a few ways you can really do that, right? You can go like work at a bank, which is not something that I find palatable at all. You can start a venture fund or work for a venture fund, or you can sort of look at the gap in the market and say, okay, how do I build a business around addressing this gap? And that gap today in climate, one of the largest is credit. So it's like the availability of corporate debt for small, medium-sized businesses, startups, and even larger companies that is really tailored to this emerging sort of horizontal asset class. And that's what Enduring Planet is really about. It's building a platform to provide sort of founder-friendly, non-dilutive capital to entrepreneurs in the climate space from inception to IPO.
I mean, I've worked in a bank and I've worked in a venture capital firm, and I have helped companies start. And it seems to me that the credit facility is the most transformative because, for one thing, the bar is a little lower in terms of what the organization has to get over in order to begin. So how does the Enduring Planet process work? What does a company have to do to begin working with you?
Yeah, so it depends on the instrument. And today we lend via a single product. We're actually launching our next product next month, so there'll be two. And the process for those will be slightly different. And as we sort of offer more instruments, the requirements, the criteria will all change because we really want to serve the broadest population of climate entrepreneurs possible. But today, for our revenue-based financing product, it's pretty straightforward. A company applies for funding through our website. So we have like an application flow. It takes about 10 minutes. They fill out some information on their sort of mission, their climate work, whether they fit certain diversity and inclusion criteria that we're looking for. We prioritize investing in underrepresented founders and diverse teams. And then they connect their financial accounts to our system. So they sort of connect their banking. We use Plaid to integrate with thousands of banks. They connect their accounting systems. We connect with QuickBooks, Xero, Zoho, et cetera. And then we take all of this raw data and we can very quickly understand whether or not this company is a fit for us or not. And so we go from that 10-minute application to term sheet in under a week.
So can you describe in a nutshell, because obviously there's a lot of complexity, what a fit looks like?
Yeah, so for revenue-based financing, we're looking for a fairly specific profile of company. We're looking for consistent growing revenue over time with gross margins in excess of 35%. We can make some exceptions there. And traditionally, we're looking for companies that are not about to run out of money. So we're not a bridge lender. We're not here to like rescue people. We are there to provide growth financing. And so one of the requirements is that with our capital and their revenue, their net runway ends up looking around 12 months by the time we invest. And so that means that we are generally investing in three cases. One is we're investing as part of a venture round where we are basically reducing the dilution that a founder needs to have. And so like if you're raising venture and you're like, I need to raise 5 million. Well, you might bring us in to invest $500,000 of that 5. You only raise 4.5 from VCs. You shave off a couple percentage points of dilution and likely retain, I don't know, $3 million worth of equity value, right? Still get the same amount of money to finance your growth, but less dilutive. Another moment that we'll invest is somewhere in between rounds, call it 6 to 12 months after a financing round. The company still has cash, they're not running out, but they want to sort of take their trajectory even higher in advance of their next round and get a way better valuation. And so we inject growth capital then. And then last but not least, we work with a lot of small, medium-sized businesses. These are often, because SMBs can't raise venture, they're often profitable, they might be smaller, they might not grow as fast, but they're still like showing really wonderful performance. And so we'll come in and just up notch, whatever the expression is, their growth. And so we have probably about 30% of our portfolio is SMB today, and that number I expect will grow because we're starting to lean harder into the SMB market through partners and sort of sourcing arrangements that give us access to more prospective SMB borrowers.
So when you make an investment, when you do a loan, what are your goals for the company in that 12-month window that you were just talking about?
So we're actually usually lending on a longer horizon. We just want to make sure that at least for a year, we have extreme clarity that they're going to be solvent. And then we can then start to influence that process and help them continue to sort of maintain liquidity, right? So we share deal flow with over 200 investors in climate. We connect entrepreneurs to additional funding opportunities, whether dilutive or non. And so we have quite a bit of ability to support the capitalization of these businesses beyond just our investment.
So you're looking at this also in terms of what value you can bring to the company.
Absolutely.
Okay.
Absolutely. So we're not just providers of capital. We have, I don't know, now close to 40 partners that offer sort of discounted and value-added services to our portfolio and community companies. We have all these investors we share deal flow with. We also have quite a bit of operating expertise within our company. And so often we'll get into the nitty-gritty with founders when they have particularly hairy problems. But, we are generally investing to support near-term revenue growth. And so these are opportunities where companies have, marketing budget that they want to invest in. They might want to hire a sales or a BD person. We're looking at the solar industry. And in those cases, like often, solar installers are constrained in their ability to grow their business based on how big the install team is. So they need to hire a person, they need to buy a truck, they need to outfit the truck, they need to get them trained, get them safety certified, et cetera. That costs a lot of money. And so if you're a small business owner, you've got 2 to 3 people, your ability to add team members actually, it's very constrained without capital. It's not like you can just go to a bank. They want collateral, they want personal guarantees, they have 3 to 5 years of operating history, profitability, all of these things that are often very restrictive, and in particular for marginalized founders or underrepresented founders.
So in that sense, you're looking at this more like a venture capital company. But what do the terms of a loan generally look like? What's the company giving up?
So the way that revenue-based financing works is that we provide capital, and then the company shares some percentage of their gross cash receipts, so their top line revenue, with us. Okay. Typically, we're investing
on a regular basis.
Yeah. So we will set a target term when we sort of underwrite. So we'll say, okay, we think you're going to grow 2x over the next 2 years based on your historical performance. Based on that model, we need 5% rev share monthly to pay off our loan in 2 years and cover our target return. If a company pays back earlier, great. You pay back earlier, likely we'll refinance and reinvest again because you're overperformed. We want to have really long-term financing relationships with our partners. If they slip, we carry that risk. So if a company underperforms, there's no collateral, no personal guarantees, no liens. We're not going to go and take your IP and try to sell it on the market like another lender might. We're there with you, and we're going to find ways to support you to get back on track. And it, in an extreme case of total underperformance, we do have some downside protection. So we generally have like a true up that happens, but that downside protection occurs on a much longer horizon than we anticipate you to pay off our loan. It's really for like catastrophic underperformance.
For our novice listeners, describe what a true up is.
Yeah. So a lot of RBF lenders, what they'll do is they'll say, okay, we have this anticipated repayment trajectory. Mm-hmm. And in a scenario where you are like really doing poorly, at the end of every year, we'll look at, you have to like sort of pay us some percentage of your principal minus anything you've paid to date. So, in our case, it's often like if we're doing a 2-year loan, we'll have a 1/3 true up over a 3-year period. And what that does is it keeps us from like losing every penny. But if we actually get paid back on that scenario, we end up losing money because of our cost of capital. Because obviously we have to borrow money to deploy money.
Now, the other thing I think a lot of folks thinking about when they hear this is what kind of team. And I want to talk later about your diversity and representativeness criteria, but what kind of team in terms of experience and skill are you looking for? Well-established, proven collaborators, people who've done a business before, or can there be big gaps in the leadership team?
So this is what's different about our model. We spend very little time underwriting teams.
Okay.
And that's because for us, what matters is historical performance. If your team has been able to deliver consistent growing revenue with strong gross margins, and you meet like all of our sort of ratio and checks, then we'll back you. There are plenty of examples in history of people who have no experience building incredible companies and people with tons of experience building terrible companies. For us, what matters are the fundamentals. And so actually what we're working towards is having a process that's almost entirely automated. Mm-hmm. And you know what? AI can't underwrite a team. And so for us, the question is, do we have enough comfort with the financial performance of this business, with their balance sheet, their liabilities, their, aged AR and aged AP, like all of the different sort of like financial metrics we can dig into? Is there enough there for us to make this kind of offer? Mm-hmm. And if we have that comfort, then we do it.
Analogous to a technical investor who looks at the market and says, now's the time to get in or not. Would you say that was an accurate assessment?
I think, public equities is like a whole other universe.
Of course it is, but we're looking for analogies for people to try to.
Yeah, so there's been this fairly big expansion of alternative credit in the financial markets over the last decade, where folks have leveraged sort of technical analysis of, AI, ML, sort of predictive kind of learning models, active learning models that take historical performance and predict the future.
Right.
And we feel pretty confident that the tools that we're using to do that give us enough sort of capacity to make those types of predictions with the borrowers that we invest in. There are a few things that give us comfort. So one is that, our capital is priced accordingly to the risk. And so we anticipate some loss based on sort of how this model works. And then two, climate presents a very unique macro condition, which is that the world's on fire. And unlike e-commerce, unlike venture-backed SaaS, where there's a lot of like, oh, the economy's down, the economy's up, like performance is down, performance is up. With climate as a whole, as an industry, we believe performance is only going in one direction, because if it doesn't, we're all dead.
Yeah, a very fair point. This is not the gig economy we're talking about. This is an enduring issue that we're going to have to address as a society.
That's right. And consumer demand is only trending in one direction. Regulatory sort of conditions are going only in one direction. And additional investment, which sort of plays alongside our capital is only going in one direction. You're looking at like the venture community, for example, right? You look at it across all markets, it is grinding to a halt. You look at it in climate, it's like just going right ahead.
It's a great place to stop and take a quick commercial break. We're going to be right back to continue the discussion with Dimitry Gershenson. We're back to continue talking with Dimitry Gershenson. He's the co-founder and CEO of Enduring Planet, which is a business financing firm. He's based in Portland. The company is virtual all over the world. Now, Dimitry, some of your case studies mention the importance of the UN Sustainable Development Goals. How does alignment with the SDGs factor into your decision-making and how you relate your work with a company?
Yeah, so when we make investment decisions, our first screen is, does this business align with sort of the new climate economy? Does it fit that first filter, right? But one of the things that's really important to us is sort of understanding and measuring and maybe even eventually predicting our impact across a broad array of impact metrics. Mm-hmm. And so when we raise capital from investors to then deploy it to small businesses, startups, et cetera, in climate, we commit to them to report impact aligned with the SDGs as a framework. It's not a perfect framework. I have lots of issues with the Sustainable Development Goals as a tool for like sort of categorizing impact, but it's one of the sort of most agreed upon globally. And so we decided to sort of come as close to it as possible for any company. So typically we identify at least one, but generally two sustainable development goals that a company impacts as part of their daily business. And then what we do is we ask them to report on a quarterly basis. Hey, here are the metrics that we agreed you impact. Can you give us an update on where you are with these metrics? And we don't attribute that impact to us. Okay, our capital is not the only capital that they're using to drive their business. And I think it's kind of flawed to think that as an investor, you're responsible for a startup's impact. But we can at the very least report that information back to our investors and say, hey, this is what your money is enabling.
We're making a difference.
That's right.
Now, you also focus on teams and communities, underrepresented communities, as a way of changing our social structure. How does that factor into a decision? When you look at the team, does the fact that there is a minority, a woman, does that make a major difference?
I wouldn't necessarily say it makes a major difference, but it does make a difference. So in our risk card and in our credit policy, we assign additional points to teams that either have an underrepresented founder, they are at least 50% diverse, and we sort of define that in our own way, or they serve marginalized communities. There's quite a lot of evidence to suggest that meeting any one of these generally, in average, improves outcomes for a business, given the sort of historical data on investing in the space. One of the sort of groups to look to, Capor Capital did some analysis on this in their portfolio. This is a criteria that they use. Calvert Impact Investments looked at, women-led teams. There's there's infinite evidence that people who have had to travel further to build their business because they don't come from privilege tend to be more resilient, perform better. So it's, go ahead.
I was going to say that Mitch Kapor, who I knew many years ago, came from a very poor background himself and really was one of the first and earliest investors to take this strategy and has fleshed it out. And there is a lot of evidence that it's like thinking about nature. The more biodiversity there is in nature, the more resilient nature is. And the same is true of a company.
Totally. And so, when we underwrite a business, obviously we're looking for financial metrics, we're looking for performance, we're looking for all of these sort of, numbers. But we also look at the team, we say, okay, if they get extra points basically for meeting these criteria. And right now, I think all but one company in our portfolio meet at least one of those three, and over 80% of our pipeline today meets one of those three criteria.
So let's talk about a couple of the companies you've invested in. Tell us about Compost Colorado. what it does and why it was attractive to Enduring Planet.
Compost Colorado provides like subscription food and organic waste pickup in the Denver area. Denver doesn't have a municipal compost program, and so folks can subscribe. They also take that compost and then process it, produce all of these like really amazing, natural soil additives, et cetera. It's like a very circular economy type business, reduces emissions from food waste. It's very much in line with sort of our climate thesis. Mm-hmm. But that team has demonstrated an incredible degree of performance over the last however long they've been operating. And they've actually exceeded all of our expectations. They're just like knocking it out of the park. We're big fans. We're big fans of this model because, one, it brings a lot of sort of climate impact. It brings a lot of value to communities. It creates this cycle of having like waste serve food security and regenerative agriculture needs in communities. And it's a fairly resilient business. Like once you get a customer who likes it and they sign up, like why would they stop? Yep. Right. Repeat revenue. Yeah. So the team, they've got a diverse team. I mean, like we're big fans. Big fans.
The other one I wanted to ask about is Aqua Oso, which is a data service provider that they combine mapping, financial, and climate data to help agricultural lenders identify solid investments. How's that fit in the model?
So as you can imagine, climate is creating a very different risk profile for capital, and that impacts the ability of end consumers, in this case farmers, to access capital to grow their farms, to convert to regenerative practices. Like you need money mm-hmm. to do those things, and if banks don't lend to you because they don't understand risk correctly, it has all of these downstream implications, often for very marginalized communities, because obviously ag isn't a place where there's like extreme wealth, at least for the people who are impacted by this model, right? Yeah. And so what Aqua Oso does is they have built a really incredible software layer that enables banks to not only understand risk at the time of underwriting, but to actually understand risk across their portfolio once loans have already been deployed, to think about follow-on financing, to think about refinancing, it provides incredible power to financial institutions to then better support farmers. And so, they're selling into a market where once a customer is landed, those folks typically stick with you because it now becomes part of their sort of core process. Two, while it might sound niche, agricultural lending is a many billion a year industry sure. in the US alone. And there's also lots of other adjacent spaces mm-hmm. where they can provide the very similar product to understand risk. So like real estate investing, you name it, geospatially sort of like align climate data and risk data is really powerful. And so they've done a pretty wonderful job of delivering on that promise, and we've been a really excited partner for them.
It is very interesting to see the scope. When you look at the investments you've made, it goes from the very technical, like we were just talking about, to the very hands-on, like composting, and that's encouraging. Let me ask you this, and you already said that this sectoral move towards sustainability is an inevitability, but with the current economic conditions, what the Fed's doing, a lot of people don't think it's a good time to start a company. Is it a good time to start a sustainability-focused company?
I think it kind of depends, mm-hmm. right? So maybe the first comment on that is starting a company is always hard. It's always been hard. 90+% of venture-backed startups never even get past the first round of funding. Small businesses fail every day. And so I think first, you as a potential entrepreneur need to make a decision. Like, is this something that I want to commit my sweat, blood, tears to? Because that's what it's going to take, right? I will say that if you're looking to start a venture-backed climate business, climate has shown incredible resiliency in terms of the investing environment. early stage deals, there are fewer of them being done, but the valuations and the amounts being deployed are fairly consistent, which is like very different from the rest of the market.
Yep.
And climate venture funds, many of them were raised in the last like couple of years, which means they have a lot of money to deploy and they have to deploy it now.
Right.
And so you might not get the price you wanted based on, if you like looked at sort of venture deals 2 years ago, they were overinflated. So now you might go to market, you might, you were thinking you could get an 8 million, valuation pre-money and you're only getting 5. Like, okay. I mean, does that really, like, if you can get the capital and you can build the business that you want, owning, I mean, obviously, like, we build our business on helping people save dilution, but in the end, like, you have to make a decision as a founder of whether or not you want to survive with the capital options that are available to you or not. And so climate has been actually quite resilient. There's an insane amount of additional financing entering the market between government grants and incentives, lenders like us starting to fill different pockets of sort of gaps within the ecosystem, project finance going earlier and earlier. I mean, there's never been a better time to start a sustainability business. And macro conditions aside, I will stick to those guns. Like the only places where it is, I think, becoming harder are places where the capital that you're getting depends on like the Fed rate, right? And so like prices are going up. But that's really just the case for like bank lending,
right?
Generally very late in the market. In our case, like where we raise capital, there's like a little bit of tie to that, but we blend money across all sorts of different sources. And so we can actually compress our cost of capital to stay very competitive in the market, even as interest rates go up.
So based on the deals you're seeing right now and the gaps you see in the market, what would you recommend somebody look at as a niche they could pursue today? What are some good business ideas that you haven't seen solutions to?
Oh man. I'm going to answer that question in the same way that I answer the question of like, what are you most excited about in the market? And my answer is everything. So there are some spaces that are getting more and more crowded, right? So like, software for measuring enterprise or corporate emissions and offering offsets. There's like, I don't know, 20 platforms doing that today.
20? Now, the thing is, I'd say 50.
Yeah. The thing is like, there's a lot of opportunity there between small, medium-sized businesses and enterprise. There's sort of compliance requirements across Europe and California. There's like all of this market opportunity. And so frankly, I think you could actually build quite an effective business if you're doing it well. Maybe you won't hit $1 billion, but you can get pretty far, right? But pretty much everywhere else, it's so early. If somebody wants to go and build another enduring planet right now, go do it. It's a $700 billion a year problem.
Well, let's take Compost Colorado as an example. It's a regionally focused composting business. Is every region ripe for a composting business?
Anywhere that doesn't have a large-scale municipal compost program that serves everyone, sure.
Does the prospect of a large-scale municipal program coming in later make that a risky investment?
I think it depends. I'm not going to speak for that team.
Sure.
I'm not close enough to the business, but I would imagine that in a lot of cases, municipal programs like that end up using private contractors to execute. And so if you have already built the network and you're already doing the work, then the likelihood that they will then not only secure your like enduring position in the market is much higher. And so I think, look, there are obviously, it is your job as an entrepreneur to go and look at the competitive dynamics in the market that you want to enter and do your homework. But I think that there's at a sort of broad macro climate community level, the opportunity set has never been greater. And there's also more and more resources to try to understand if your ideas are valid and getting traction. So you can join communities like My Climate Journey, Work on Climate, New Energy Network, You can go and take courses. There's the climate-based fellowship program. There's the Terra.do like climate boot camp. There's so much out there today that did not exist. So, I've been in climate for, oh my God, 13 years.
Mm-hmm.
Okay. And when I left undergrad, none of this existed, right? Even when I left grad school in 2015, God, when was that? 2015, none of this existed.
Yeah.
Right. And so today you want to get into climate and you've been a data scientist in big tech, you have an ocean of resources to transition into a different job. And you want to start a business, like there's all of these places to go to get validation and feedback. There's most of these communities that exist on Slack that have 5,000, 10,000 people, all of them have a startup ideas channel where people just throw stuff out all day and get feedback.
Now, your site, enduringplanet.com, has a lot of articles by business and financial people explaining how to build a business. What kind of information can people find there, and what do you recommend they read first?
Yeah, so when we started Enduring Planet, one of the things that we consistently kept sort of encountering was that this ecosystem has a long way to go to build the kind of, I'm going to use this term very carefully, like financial literacy around fundraising, capital management. And I think this is probably true everywhere, but climate is in some ways unique because you often have folks coming in from very technical roles, trying to build companies without necessarily bringing in seasoned operators. And even then, often founders fall into these traps because they're surrounded by, VCs or whatever, who will like tell them, oh, you're a venture-backed company, you only raise venture capital. It's like, it's terrible advice. And so we wanted to provide perspective. It's partially our perspective and partially expert perspective on very tactical issues at the intersection of climate, entrepreneurship, and capital. And so every week on a Tuesday, we publish it's like a synopsis of a conversation that I have with an expert. So sometimes we actually publish the recording of the conversation. It's like sort of a blog, not really, no production. It's very, very sloppy, very raw. But we publish this written piece that people can reference over time. And so we've covered everything from how to build a really awesome data room to how to raise capital from private foundations to, navigating stalled rounds to, thinking about your first industrial pilot and how to sort of leverage that to raise additional capital. And so for us, the goal is to provide what we think is very like high quality tactical insight into saying, okay, I have this one problem. How do I solve that?
Right.
And over time, to build a library where basically at any point in their entrepreneurial journey, a climate founder can go and say, okay, I need to find a law firm to represent me for my Series A, and we'll have a piece on we haven't done that one yet, but we will. I need to figure out how to negotiate this term because this term is really complicated. And so we'll have a piece on that. And I don't know if there's any individual piece I'd recommend. I think it kind of depends on what you need to
Jump
learn.
in and browse.
There's, I think we've been publishing content now for about half a year. And we have about another half a year already in the works or produced. And I think as we grow, we'll start to expand that base and maybe create sort of repositories of information. But one of the things that we want to be careful of is there's an incredible amount of really good resources in the market today, right? Podcasts like this one, which educate people on all sorts of different things around sort of building a business, how they think about a market. Resources like Climate Tech VC, where they produce incredible insight about sort of the venture side of this ecosystem. And what we want to do is offer something that's fairly niche, right? It's tactical advice at this intersection. And I don't want to produce reports on the venture funding ecosystem. That's not for me. That's for Sophie and Kim to do. That's great. And people should go and learn about all these other resources because there's just so much out there. This is the other thing is there's not just community now. There's all of this educational insight in the world to give you the tools you need to like successfully build a business in the space.
Well, and, like the rise of technology, which started, or I should say, was catalyzed by things like the computer fair. These resources are blossoming all around us, and it's only a matter of reaching out and taking them. But I want to thank you for taking time to talk with us today, Dimitry. It's fascinating. We'll point people to Enduring Planet. Thanks for the time.
Thanks so much, Mitch. I really appreciate it.
We have been speaking with Dimitry Gershenson. He is the co-founder of Enduring Planet, a debt financing company working to catalyze the climate startup community. There isn't a lot to add to Dimitry's comment that now is the best time, so far at least, to start a sustainability or climate-focused company. The climate crisis has made the human and business response inevitable. We have to figure out what to do, and we have to get out of this mess, and we have to do it together. But the thing to emphasize, I think, is that while the world is burning, it's important to recognize there are many solutions waiting to help solve the problem. It's not like we're stuck in the middle of a wildfire without a fire hose. There are fire hoses lying all over, waiting to be picked up and used systematically to change humanity's trajectory. So I hope you'll take a moment to share this show and explore our archive of hundreds of interviews. We capture these stories, but it's you, dear listeners, who are the amplifiers that spread these ideas to others. More ideas can lead to less waste and a solution to the climate crisis. Let your friends, family, and neighbors know that they can find sustainability in your ear on Apple Podcasts, Spotify, iHeartRadio, Audible, and all the other fine dispensers of podcast goodness that you count on. I'm Mitch Ratcliffe. We'll be back with another innovator interview soon. In the meantime, folks, take care of yourself, take care of one another, and let's all take care of this beautiful planet. Have a green day.